What's up, everyone? Welcome to How to Invest. I am here with my sister Abby, and we're going to be talking about what some really important stuff to understand is before you start investing. We're going to be talking about just stuff that you have to be prepared for. It's not easy, but it's way easier if you know about it ahead of time. And just some stuff that you should really know before you get into this to even know if this is something that you want to get into. You want to say hi?
Yeah, hi, my name is Abby. I am investing, but I don't know a ton, so that's kind of why I'm here.
So she is kind of here to make this more of like a conversational. So I'll be teaching, but that way if she has any questions, she'll kind of act on your behalf if something's not clear that I'm teaching, and we'll hopefully add a lot to the conversation in that way. Plus, I feel like if I'm teaching my sister how to invest, that kind of changes the dynamic a little bit, which will hopefully make the videos more enjoyable and feel more personable than if I'm just talking to a camera.
And you don't want to leave me wrong, I'm your sister.
Yeah, exactly. And I am actually teaching her, and you know that if I'm trying to teach her this stuff, this is like what I really believe. That doesn't mean that everything I believe is going to be 100% correct, but I'm not trying to lead her astray. So I'm teaching everything that I believe is true. Just a little bit of background on me. I learned from the legendary investor Peter Lynch through a lot of his really great books like One Up on Wall Street. And I would really say that Peter Lynch has been my mentor. And thanks to a lot of his teaching, I've done really good in the stock market. In the last 5 years, I've averaged well over 70% annualized returns. And in the last 2 years, over 100% annualized returns, which is really crazy. If you know anything about investing, like that's really, really insane. Peter Lynch averaged 29% annualized returns, which is just crazy when he worked for Fidelity. So my returns have been from being a little bit reckless, but that's not what I'm teaching you. I use a lot of margin and stuff, but that's not what I teach at all. A lot of just the fundamental truths, though, that Peter Lynch teaches are I think why I've done so well, and that's what we're going to be teaching here. So without further ado, are you ready?
I'm ready.
If I ask you what is like one of the most important things that you have to know about yourself or about investing before you started, what would you guess it is?
Long term is better than short term.
Yeah, sure. So I think that's actually pretty close to it. So I think one of the most important things about investing before you get into it that you have to know is that if you're going to be investing money that you need in the next couple months, then that's a really, really bad idea. It's going to make you a terrible investor, because it is really hard. In fact, I think Peter Lynch would even say it is impossible to know what's going to happen to the stock market in the next couple of months. I would even say the next couple of years, because there's a lot of events that can happen that scare the market. And if the market gets scared, it can sell off a lot. And I think this is why a lot of people who invest lose money in it, because they don't understand that they have to leave their money in the market for the long term for companies to really get valued differently based off of their growth. And like, even if a company is growing 30% a year, it's like, if you want to double your money, you have to wait a couple of years before that company is going to double its net income. And over the short term, it's a really important thing to understand. Over the short term, the stock market, it's a voting mechanism. So it's about how people feel in the moment. People are voting on how successful something is going to be in the future or not. And when people are feeling down, they vote stuff really down. And when they're feeling up, they vote it really up. But in the long term, it's not like that at all. In the long term, it's a weighing mechanism. Actual value.
So it's kind of just like people want to build trust in the company over time. That's why short term is reckless, because people, their trust will go up and down. But once they see a company has been for a long time doing something good, they feel a lot more trust in it. So that's why long term is better.
Over the long term, like you can literally chart, like McDonald's, for example, you can chart its net income over the last 50 years and how much it's grown, and then chart its stock price, and it's grown like exactly the same, like within a couple percentages. So over the long term, what the company that you're buying actually does is going to be what determines the price. But in the short term, it can be any headline or news event or anything like that.
Yeah.
And that means that if you need the money, I would say even in the next year, it's very risky to put it in the stock market. Okay, so then a second thing. So yeah, that was good. Understanding that, yeah, if you're trying to trade and just make like 20% tomorrow, it's like go watch another trade or another channel that is going to teach you voodoo on reading stocks and stuff, and you might even get lucky, but that's not investing.
It's more like gambling.
Yeah, that's a lot more like gambling. Another thing that kind of ties into this that's really important to know before you start investing is that the stock market goes down, and it goes down often. So over the long term, it's like you look at a chart of the S&P 500, and it's just like up and to the right, up and to the right. For you guys, I'm not sure how that goes, up and to the right. But over the short term, it's like there's a lot of bumps, and the stock market drops at least 10%, like on average every other year.
I've definitely seen that
But
in my
that,
investing.
yeah, but that doesn't mean that it can't go up 3 or 4 years in a row just because it's an average.
On average, yeah.
But then there's also going to be times when it goes down more than 20%. And in those stocks, if like the S&P 500 goes up 20%, individual stocks will move even more than that. So in a market that's down 20%, it's like the specific stock you own could be down 50% or 60%. And that could literally be a normal fluctuation and have nothing to do with the value change of the company in the short term. So even though in the long term, the stock price is going to follow the company value, in the short term, people's emotions can have your stock prices double. Like if it drops 50% and then goes back, you literally lost half your money and then it doubles.
Yeah, that's really scary.
Yeah. So it's scary, but it also provides a lot of opportunity.
Okay.
But then if you understand the fundamentals, and this is going to be the third thing. Okay. So long term, understanding the stock market goes down. The third thing is actually understand the fundamentals of what you buy. That means that you have to, and this is what the next video will be about, how to actually build a story on a stock, but you have to understand the fundamentals of what you own. Because if you understand that your company's revenue is still growing even though the stock went down 50%, then you don't actually have to be scared. Because the stock price fluctuating and the market telling you, oh, this is the price they're willing to pay for it right now, you could be fearful if you don't understand, wait, they're kind of crazy because I know the company I own is selling even more this year. They're making even more profit. Like 5 years out, this price is going to seem crazy. And that is how you have the conviction. And this is how you get really good returns, is in those moments of freak out. That's where you can make the most money because you understand the value of the company is still really not deteriorated at all. And now you're literally buying it at a discount. It's like going shopping and you're like, oh, I knew these eggs are still good. I get them 50% off. That's crazy.
It's like buying winter clothes in the summer because you know that they're on sale or vice versa.
Yeah, exactly. That's a lot of what makes a good investor. So that kind of to play into this, like I think another reason why a lot of beginners lose money in stocks is because when they're buying a house or buying a washer machine, they might do 2 or 3 days of research and then they call an inspector to come and look at the house and they want to make sure the foundation is good. And that's honestly why, like a lot of people, like the one good investment that most people make who are able to get to the point of being able to buy a house is a house, because you hold it for a long period of time. You're not trading in and out of it when there's a lot of fear. If your interest rate is fixed, it's like you can just hold it for 20, 30 years and that is going to cause it. That's when something appreciates a ton. But then when they go and buy a stock, they just go and they said, oh, my friend mentioned this stock, and then they go to Robinhood and they just put $500 in it. And they know literally nothing about it.
Yeah.
So people don't treat it seriously at all. And it's like, if you don't treat it seriously, then you are just gambling and you're not going to make money in it. And if you don't understand what you bought, then guess what? You're going to be one of those people panic selling when it falls 50%. And you don't even know what it does or how it's doing. So you're going to think things are terrible in the company.
Yeah. If you're just looking at the stocks, what the stocks don't actually show how the company itself is doing. It's just showing what the social kind of idea around it in that day or week or month is.
Yeah.
Not like, oh, we actually really like this product, it's gonna help mankind or something. But it's just like, oh, well, someone said something maybe a little bit bad, so bye, like sell your stock like that. Yeah, you're kind of running before you can really get returns on it.
Yeah. So like one great example of that right now, apart from how like the valuation of it is Tesla. Like right now, because the CEO of Tesla has become more political, and there's like people that are like burning stuff, and I don't think it's actually happening that often. I don't think it's as big of a deal as it seems, but it's getting a lot of news coverage. And every time something happens, it's like everyone hears about it, and it creates a lot of fear. So the stock just crashed 50%, and it's like they're about to release a new model, they're about to start full self-driving, and it's like if you're watching this video 5 years out, you might know what the story of Tesla turned out being, but in the moment, like 3 months ago, it was worth twice as much as it's worth now, and like the value actually dropped 50%. Or it's just the political dynamics and the fear and people's feelings, their optimism about it. That's why, like Warren Buffett used to say that like the stock market is like if you owned a house and your crazy neighbor some days would take his meds and some days wouldn't, but every day would come up to your house and scream how much he was willing to pay for your house. And it's like your actual house isn't changing in value based on what your crazy neighbor is screaming, but. A lot of people let themselves get freaked out when their crazy neighbor doesn't take their meds and then does that.
One thing that was super important that you taught me is just because you have, quote, lost money in your investments, you actually didn't lose anything at all except for just the dollar amount that it's worth, but you still own just as much of the company. And so as that company goes up, that will continue to go up. So it's kind of, it feels like, oh no, I've lost all my money, but you have stocks. There's something else that it's exchanged for. It's not just money out in the atmosphere that's gone and then sometimes it's up. And that really helped me. So I just kind of stopped looking like every day at what was happening. And even actually, if someone said that stocks were doing really good, I'd check and be like, wow, it's doing really good. And that would help me know, because I own part of this company and that value doesn't go away unless the company completely went out of business. So that definitely is important to understand.
Yeah, no, and even if you understand it, it's like, even I still, oftentimes I'm sitting there watching the stock price. And
I know
like,
you do.
go up, even though I know that it's like, really the daily movements don't have anything to do with the long-term outcome.
Yeah.
And you really should be looking at companies with a much longer-term perspective. So.
Why do you think you do that?
Well, it's because I use a lot of margin. So I'm trying to be too smart, really. No, like that's really the issue. No, it's and I don't think it's actually possible to predict what's going to happen in the short term.
Yeah, of course not.
So, yeah, it's all settled down a little bit, but it's also because I had the experience early investing where I like all in on Tesla and at like 20x. And that was like such a crazy experience and wealth change that happened so quickly that part of me doesn't like owning too many stocks.
Okay.
We'll talk about that in a video as well as like building a portfolio and that sort of thing. Is there anything that you've learned investing that you think is really important before I do the last point? Because Abby's owned Tesla for like 4 or 5 years, maybe 6 or 7 years.
Something like that. Yeah, a lot of my investing started really with mom and dad money that was saved away for me from a grandparent dying or something, and
just a couple $1,000s though.
Yeah, exactly. And they put that money in for me. So most of my investing experience really has just been other people investing for me.
But you've seen the gains and you've seen how much your portfolio has grown.
Yeah, I definitely have, and that's been super exciting. And so as I've gotten older, because I'm only 22, so I'm just getting my own apartment and all of those kind of things. So I'm really like, okay, this is important to know where my money is going. So really the most important part for me has been to learn from somebody who is doing all of the research, who is doing, like, understands what the graphs mean and the different language, and kind of helps bridge the gap between that, which you have been able to do for me. I've been super lucky. I know that you are really passionate about investing. You love doing it. You love researching it. You love being on earnings calls, which most, I think, average people don't like doing. I know I don't like doing that. But going to somebody who's honest and who has their own money kind of in the game has been good for me to be like, okay, if you're really passionate about this because you have put in the time and research to look at that. And that doesn't mean I shouldn't do any of my own research by any means.
No, like you guys should definitely understand the companies you own. And I think you do understand a lot, but I could do even better helping you get educated on that. But that is going to go into the final point here is like, because this is a long-term game, you guys should have a plan to actually invest money every single month. I think that's really important. And this is not something where you put $500 in once, and then you never think about it again. You can do that, and that's like not too bad, but you're going to actually change your wealth, like your life, your future, and grow your portfolio so much more than you could ever believe if every single month you're just putting in like a couple $100 or $500 or $1,000 or however much you can. And just know that you're not like giving up this money. What you're doing is you're paying yourself. Like you're paying yourself in your future. And shouldn't you pay yourself some of what you make? Like, shouldn't you pay yourself some of what you're working every single day, however many hours a day that you're working? Shouldn't you pay yourself some of that instead of, paying the grocery store owner and the gas station, and you pay everyone else?
Or the bank.
Yeah, the bank, your like mortgage company or whoever owns your rental apartment. You're paying all these people, but you're not paying yourself anything.
Yeah.
So set yourself up in the future by paying yourself every single month. And if you actually do that and you're keeping up with that, like you are going to have a ton of success. And I think what Abby said about having someone to help motivate you, that's really true. It's much easier to do something with others than by yourself. So if you want, and I would say don't do this, by the way, unless you actually do want to invest at least $500 a month. But if you want to join our community, I will be making monthly videos that are just for our supporter community every single month, motivating you guys like, here, let's put another $500. I'll be showing you what buys I'm making as well. So it is kind of like the relationship that I have with my siblings, where you know exactly what I'm doing, you know exactly what I'm thinking. I'm motivating them every time that they're getting paid, like invest, like buy the stock. So that kind of vibe to help you actually keep this up.
Yeah.
One
thing important, you don't just say buy the stock. You say buy the stock because they are innovating or they are doing super well in this market. They're doing something new. They're doing something exciting that people are really...
So that's perfect. So if you enjoyed this, drop a big thumbs up. And now click on the next video, which Abby was just alluding to, which is creating the story so that you actually know which stocks you should buy. And we're going to go into how to develop a story and how to know whether or not a company is a good buy. So we'll see you on the next episode of Investing for Beginners.